Hey, what's up? Welcome back. Dapper Dividends here. I'm Russ. We're going to do some surface analysis of GE in this 44th consecutive video, so let's get into it. GE caught my attention with the headline last week that they have filed a lawsuit against Siemens Energy over some shenanigans that were going on with a bid contract over gas turbines that were to be supplied to Dominion Energy. They say that they had trade secrets that were leaked by a Dominion employee to a Siemens employee, which ended up allowing Siemens to undercut them and win the bidding contract, which hurt them for millions of dollars, they claim. So we'll see what comes of that. But it got my attention. It got me thinking of GE. Now, I don't own any GE, and we're going to do some really quick surface analysis here to see what's going on with GE and if they are a good dividend growth opportunity. GE is a high-tech industrial company founded in 1892. They operate through power, renewable energy, aviation, healthcare, and capital segments. So they are pretty well diversified. 75% of their revenue do come from the aviation and energy. If you look at their returns over the last 5 years, it is just terrible. Negative 53.8%. 5-year return with dividends reinvested. That is just awful. Revenues are declining. The earnings are flat. They were unprofitable from December of 2017 to September of 2019. So at least they are now profitable. They've got that going for them. 4.2% profit margin, which is not something that I am thrilled with. And the earnings growth over the last 5 years is negative 28.9%. Looking at the dividend, which has been paid for over 120 years, 92% cut in 2018, down to a penny where they're at today, which is a 0.35% subatomically microscopic dividend that they are paying out. That is currently good for 10% earnings per share payout ratio, but I calculate 24.77% free cash flow payout ratio over the trailing 12 months. The interest coverage ratio is a metric I love looking at, and it's currently 0.43. That means they have 43 cents of operating income available for every $1 of interest expense. That means they are not able to pay the interest on their debts, which doesn't make sense to me why they even have a dividend. If they cannot even pay the interest on their debts, I would have just cut the dividend, just eliminate it, turn that ship around even faster. I like to look at 3 analyst values. Simply Wall Street has them valued at $15.46. Yahoo is at $11.50. And Morningstar has an $11.10 valuation. Average the 3 together gives $12.69, making them potentially 10% undervalued at the current price of $11.33. What I think of GE is terrible. It's awful. I would stay away as a dividend growth investor. But with that being said, there is some opportunity there. As the new-ish CEO, Larry Culp, had sold off the GE Biopharma for $21.4 billion, and they are in the process of selling off their interest in Baker Hughes, which in 2017, they merged their oil and gas services into Baker Hughes. Oil has been doing terrible, getting crushed. They are divesting themselves of that. They're trying to make changes. They're turning the ship around. GE is a very big ship, and it's going to take a long time to turn it around. It's not going to be quick, so patience will be required. I'm not going to get into it. I give it a thumbs down from a dividend growth point of view. If you want an opportunity for a long-term turnaround, this is fantastic. If you can buy some GE and just forget about it, understand there's high risk. I think that there's a potential that they may have to spin off and unlock value of some of their other segments. We'll see if that happens. It's fun to watch. We never know what's going to happen. That's my surface analysis. Thumbs down. I'm staying away from GE. Expertise comes from the community, so let me know what you think about GE, and I will talk to you in the next video tomorrow.